My name's Tom Harden. I'm the Chief Investment Officer at Canterbury Investment Management. We're all aware that the financial markets are getting a lot of attention, and it hasn't been positive. Before we get into the state of the current market and how we can potentially benefit from the market's behavior, I'd like to talk a little bit about how markets work, and more important, what drives different market behaviors. Liquid financial markets are driven by supply and demand, the supply and demand for the traded shares. Supply and demand is driven by investors buying and selling actions, and their actions are in turn driven by their beliefs about the future price, what that's going to be, and how strongly and emotionally they believe that their predictions will come true. If more people are selling than those who are buying, then the price will go down. In the opposite, if there are larger orders to buy than to sell, then the price will go up. Investors tend to vacillate between two extremes. One is the rational wisdom of crowds, and the other is the irrational madness of crowds. So we'll start with the intelligence of crowds. A group of rational individuals are more knowledgeable than any single person within the crowd. Most of the time, a group of investors will assess information, process it, and then act in a rational manner. The buying and selling actions of rational investors help to maintain an orderly and efficient market and normal price fluctuations. Then we have the madness of crowds. Sometimes the group of investors will overreact in response to an unexpected high-impact event. Emotional investors become irrational in their buying and selling decisions. They act in a herd-like manner. They all move in the same direction at the same time. Their actions create high volatility as a result of a series of large daily fluctuations. They're both sometimes up and down. Markets typically behave within three primary environments. The first would be a rational or bullish environment. A rational or efficient market has low volatility. News events typically have little impact on the price. Declines in a price should be limited to a market pullback, which would be defined as about 5% down from the previous high, or a correction, which is typically somewhere in the neighborhood of about an 8 to 12% decline off the highest value. Bull markets trading anomaly, a bull market trading anomaly. Short-term period of large daily outliers that tend to follow a series of new market highs and extremely low volatility, which is a bullish environment. These trading anomalies create short-term anxiety among investors, and in some cases, investors will confuse these anomalies with the end of a bull market and the beginning of a new bearish environment. Now, unlike a bear market, these anomalies don't last long, and the amount of time to establish a new high in value should occur within really a few weeks or even a few months. Then you have a bear market. A bear market is an extended period of high volatility and numerous ongoing single-day outliers that can be 2% or more, again, up or down, mostly down. Bear markets will display a downward stair-step looking pattern. In other words, you'll see it go down, low, a little bit of a run up, but lower than the previous high, lower low, lower high, lower low, and they're volatile. According to a study conducted by Charles Schwab, bear markets last on average about a year and a half, and they average about a 38 or 39% decline. So the question is the bull market over, and are we now in a bear market? Well, conventional wisdom says that a bear market is defined as a 20% decline from the peak. We saw a 20% decline in just 15 days from the peak on February the 19th, which was a bullish market environment. That's the fastest 20% decline recorded in the history of the markets going back to 1896. So through today, the decline has been about 27%, and only one more day's passed. Now, this kind of parabolic decline is an extreme example of an emotionally driven market pricing anomaly. Such moves tend to reverse themselves and quickly. Now, don't get me wrong, obviously a 20 or 25% decline is significant. That said, we only make money when the market, or in our case, the portfolio, puts in a new high in value. So the length of time that passes between one high in value of the portfolio to the next high is what's truly important. Now, over the history of the markets, there have been many devastating events. There have been wars, depressions, a sneak attack on Pearl Harbor, presidents being assassinated, terrorist attacks, and the 2008 financial crisis, and the list goes on. Now, to put the current coronavirus in perspective, I don't think that many people expect the coronavirus to turn out to be one of the largest disasters to be experienced by mankind over the last 220 years. From what I've heard, it's most likely to run its course over a few months. The economy was in the strongest state that it's been in decades coming into this. There will probably be some form of federal aid. They'll take some of the sting out of the economic impact. And things will most likely return to normal sooner than later. Now, that said, the irrational short-term decline is not about the coronavirus as an event. It's about the emotional state of investors. The last 16 days have been dominated by panic-driven investors who are all doing the same thing at the same time. What I do know about is how market panics play out. Emotional selling panic is the opposite of a highly emotional buying that causes a bubble, kind of like the tech bubble in 2000. We all know how bubbles end. They bust. Selling panics end with equally emotional panic buying that typically regains about half or more of the total decline. This is called a kickback rally or an oversold rally. They mostly occur before the worst of the news is out, and they happen when most would least expect, and they happen fast. Bottom line, human behavior is predictable, especially when it comes to crowd psychology. The size of the percentage of daily declines will have less relevance because the following rallies are typically of similar size. In other words, an irrational 10% decline over two or 3 days can quickly be corrected over just a few days. We're in the midst of an anomaly that followed an orderly market with low volatility, a bullish market environment. Our studies show that markets do not go from a bullish environment into a long-term bear in a matter of days. Bear markets evolve through a series of changes in behavior. We do not see the characteristics of a sustained bear market. Instead, we see this clearly as an example of panic selling that is typical of the madness of crowds. In the event that a bear market does evolve, we have the tools to stabilize the portfolio. Investing is a lifetime process. Markets have always established new highs. The most common mistake made by investors and portfolio managers is to follow the crowd and sell after an emotional decline. You have less invested on the way back up than you did on the way down. Canterbury, we will stick to our process and expect to benefit from the volatility as time passes. Thank you for your confidence, and we'll follow with additional actions when needed. Thank you.